What's going on, guys? This is Minh with What's a Mortgage. Welcome to our live stream. The goal of our live stream is to educate, empower, and to connect you with the right mortgage. And tonight, we are going to talk about who is the champion when it comes to down payment assistance. We have CalHFA, one of the most popular down payment assistant program. And now we have GSFA Platinum, right? Who is contending for number one. And which down payment system will be best for you and your family? And tonight, we're going to break it down because each person or each family will have a different one that they favor more. And tonight, we're going to break down so you can decide who is your champion. All right, guys? If it's your first time tuning in to our live stream, do me a favor, hit the subscribe and notification button so you're notified every time we go live. We go live Mondays and Wednesdays on Facebook, Tuesdays and Thursdays on Instagram. So definitely, if you're not following us on Instagram, check it out. That's where we post a lot of stories. I do my rant. Also, we leave a lot of tips in our Instagram stories, right? So definitely come check out our stories. Also, guys, this live stream is interactive. So interact with me, right? Let me know if there's something you want to know about What's a Mortgage, right? Also, guys, if I bring you any value tonight, do me a favor, right? And tag and like this video. Please tag someone that you know would benefit from this video, and also like it, please, right? It helps with the algorithm. Okay, guys? Hopefully you're having a great night. What's going on, Janae? How you doing? What up, Carlos? RJ, what's going on? Escrow buddy, right? RJ and I were both in escrow to buy a house right now. I think he's coming closer than I am, right? I think he's next week. I'm the week after. What up, Al? What up, Mike? Don't buy a house right now. That's the worst thing you can do this economy. If that's what you think, Mike, if you feel like buying a house is the worst thing to do in this economy, then don't buy a house, right? Talk to any lender, talk to any realtor. Why don't you go out, Mike, and write an offer on a house to see if you can even get it accepted? The people who are unemployment right now are typically people who don't own homes, who won't own a home, who live at home with their parents, right? People who are in mortgage forbearance right now, over 50% of them have made their mortgage payment. Also, if you do own a home, right? And you have to go into foreclosure or you can't make your payment. They have 80% of people in forbearance have 20% equity or more, right? Only 1% of people who are in mortgage forbearance are underwater. So tell me that. I don't know. And they're not building new properties right now because of COVID. So there's the limited amount of supply, but there are more people in California making money who are working that can afford home ownership. I just want to leave it at that. What up, Lisa? How you doing, girl? Guys, let's get into it, right? If you're thinking about buying a home and you're thinking about doing down payment assistance, right? Which one is best for you, right? So let's get into it, guys. So the two main down payment assistance programs right now that everyone is talking about is CalHFA, right? California Housing Finance Agency, and GSFA, Golden State Finance Authority, right? These are the most two popular programs. Yes, there's other city programs. Yes, there's also Chinoya, but right now, pound for pound, these are the two most popular programs. But every program has their caveat in which one is best for you and your family, okay? So let's get into it here. Oh, forgot to click the side button. Let me tell you a story about my buddy James, right? James is a guy who went to school with me. He had good grades. He graduated, went to college, met his college sweetheart, and then had kids. Life smacked him, right? He had kids. He has bills. He's paying rent. He has his wife, right? Every time James has a chance to get ahead in life, another bill would pop up. There would be car problems, right? Or his daughter needs braces, right? James can't seem to catch a break. He can afford the mortgage payment, but he can't catch a break to start saving money for a big down payment, right? Talking to his parents and his parents' parents and his friends, they're like, you got to save this huge down payment to buy a house. But of course, year after year, he becomes discouraged. And guess what? James doesn't get a chance to enter home ownership. Does that story sound familiar to you? But guess what? Now, James can go from either a CalHFA loan or a GSFA loan. It gives James a chance to enter home ownership, right? So let's start with CalHFA, the champion right now, right? Up to last year, CalHFA was the undisputed champion for years, right? But a lot of guidelines changed for CalHFA, which made GSFA catch up. But still, CalHFA is still popular among a lot of first-time home buyers, right? So the California Housing Finance Agency, okay? So there is, how does the CalHFA work? The way it works is it's a loan, not a grant, right? They will loan you the down payment up to $10,000 in the majority of the closing costs. The minimum credit score is a 660, right? There's 2 versions of the CalHFA and there's 3 levels of it, okay? So there's a conventional version and there's an FHA version. Yes, you'll go on their site, you'll see other versions, but the 2 main, pretty much 99% of people who do CalHFA, they're either going to go with the conventional version or they're going to go with the FHA version, right? And there's 3 levels of each version. There's a no zip, which means you're borrowing just the down payment, which means you got to come out of pocket for closing costs, or you can ask the seller to cover closing costs or increase the purchase price to cover closing costs. Right now in this seller's market, it would be really hard to get the seller to pay for closing costs, you know? So definitely the no zip is out there. It all depends on the situation. If you can get a no zip, right, then you would only have to come in with maybe some closing costs, or if your down payment is above $10,000, you would have to come in with the difference. Okay. Second level, the 2-zip. The 2-zip would give you the down payment up to $10,000 and then 2% for closing costs. Closing costs on these down payment assistance are probably going to be with the 2-zip covering the loan officer's commission or the lender's commission when you do down payment assistance, because you are taking a higher rate. The lender doesn't get to keep that money like they normally do on regular loans. That's going towards your down payment and your closing costs. If you do a no zip, the rate is of course lower. You do a 2-zip, the rate's a little bit higher, right? You still got to come out of pocket between 2.5% to cover the rest of your closing costs. And then there's the level 3, the 3-zip. The 3-zip will cover your down payment up to $10,000 and 3% in closing costs. Typically, you'll still have to come out of pocket between 1 to 1.5%. Why is that? When you're buying in September, October, and November, closing costs are higher because impounds are a lot higher, okay? So right now, if you do a CalHFA, right, typically because they're loaning you up to $10,000 in closing costs, the greater the purchase price, you're going to come out of pocket more money on the CalHFA. If the purchase price is in the low 300s, which you can't find unless you're in Central California, or if you're in San Bernardino County, maybe parts of Riverside still. But Orange County, LA County, most likely it's not going to happen, right? But if you're looking in Central California, Kern County, Central California, San Bernardino, you'll still see the 3s. When you're in the 3s, it's not as bad. But as you climb up, remember, they're loaning you up to $10,000. Remember that. But they're going to loan you either 2% of the complete closing costs of the loan amount or 3%, right? So at least you'll still get majority of your closing costs covered. Remember, when you do these down payment assistance, closing costs are between 4 to 4.5%, okay? So next slide. So here's a breakdown how it works. When you do a CalHFA loan, there's 3 loans, right? Unless you're doing the no zip, then there's 2 loans. It's just the main loan, right, which is either 96%, 96.5% or 97%, depending if you go FHA. If you go FHA, it's 96.5. If you go conventional, it's 97%. Okay, and then there's the second loan, which is the down payment, which is either going to be 3% down or 3.5% down, up to $10,000, right? And the third loan, which is either going to be, if it's no zip, there's 2 loans. If it's the 2-zip, it'll be the 2% of the loan amount, right? Or the 3-zip, it's going to be 3% of the loan amount to cover closing costs. Remember, when on the third loan, right? So the first loan and the third loans, On the third loan, there's 0 interest, right? You only have to pay it back when you sell or refinance. You cannot subordinate. The second loan, right? The second loan is based on 3.5% simple interest. So if the second loan was $9,000, it's $9,000 times 3.5% divided by 12, and that's your monthly payment on simple interest if you're borrowing money on the second, which you are, 3.5%. Okay, so that's how CalHFA works. There's 2 versions. There is a FHA version, there is a conventional version, right? And there's 3 levels. There's the no zip, which means you're borrowing the down payment and the main loan. There's the 2 zip, will give you 2% for closing costs, the down payment and the main loan, or the 3 zip, which will give you 3% for closing costs and the down payment and the main loan. Okay, so that's how the CalHFA loan works. It's a loan, not a grant or a gift, right? Which we'll talk about in the GSFA. So pound for pound, it was a great loan until they changed it to $10,000. Because when you start climbing in the bigger loan amount and purchase prices, of course, if you go $500,000 purchase price, 3% is 15 grand. You're only going to get 10,000. So you would have to come out of pocket 1 to 1.5% of the closing costs. Plus, you're going to have to come out of pocket that extra 5,000. So as you climb higher and higher, you'll start seeing the CalHFA might not be to your best interest. Okay. So remember, it's a loan. Okay. Next slide. Let me get back here. Right? So here's an example of a conventional CalHFA loan. Okay? So if the purchase price was 300 grand, 3% down would be 9,000, and the new loan amount would be 291. So you would be borrowing on the no zip the 291 plus the 9,000. On the 2 zip, you would be borrowing the 291, the 9,000 plus the 5820. Okay, on the 3rd zip, you would be borrowing the 291, the 9,000, and the 8730. Okay, so that's how the loans are broken down on a conventional version of the CalHFA. Okay, let's get into the FHA version. Okay, so here is the, let's see here, ooh, slide didn't move. The FHA version. Okay, remember, it's going to be 300,000. Even though the full down payment is $10,500, they're only going to loan you $10,000. You got to pay that extra $500. And then there's upfront MI, so we'll give you the new loan amount of $294,566. The second loan would be $10,000. Okay, if you did the zip 2, it would be the $294,566 plus the $10,000 plus the $5892. Same thing with the third loan. You get what I'm saying? So remember, with these CalHFAs, when you sell the house or refinance, you must pay off the second and third loan. Okay, typically these CalHFAs, right, will have lower rates than the GSFA because you're borrowing the money. It's not a gift, it's not a grant, you are borrowing the money. Okay, so now we know how the CalHFA works. Okay, let's look into some guidelines really quick here. So if you're buying a home with a CalHFA loan, right, you must be a United States resident. Okay, it's a first-time home buyer, which means you cannot own a home for 3 years, right? And you have to be a first-time home buyer, which means they're going to ask for 3 years of your tax returns to make sure you didn't write off any mortgage interest, right? It is owner occupied. If you had a cosigner, the cosigner cannot own a home as well. You cannot buy units. You can do FHA condo as long as not in mitigation, right? The condo has to be FHA approved if you're doing the FHA version. If you're going conventional, it must be a warrantable condo on conventional. Okay, you can do manufactured homes, but you do need a higher credit score. But for the manufactured homes, you have to go FHA. All right, so that right there is the identity guideline. Let's look into credit. Depending if you're going on the conventional version or the FHA, you must follow the conventional and FHA public record guidelines regarding bankruptcies, Chapter 13, bankruptcy 7, 11, or 13, your short sales or foreclosures, right? The minimal credit score for CalHFA is a 660 score. If you are in the 700s, you can compare the payments, but typically above 700, the conventional CalHFA will be a cheaper payment than the FHA version, right? Also, if you're going with the FHA version, you cannot have defaults on student loans because the FHA version is a government-backed loan. Okay, guys? hopefully this information, right, gives you perspective if CalHFA is for you. Okay. Next one. So this is what changed CalHFA a lot. CalHFA went from 50% DTI to 45% DTI, now to 43% DTI. So you get less home with a CalHFA, right? You get less home. You can only go up to 43% DTI. I don't think that's a bad thing, actually. I think it's a good thing, right? Keeps you balanced, does not give you a choice to go crazy and put yourself in a bad position, right? So if you made 50 grand, that's your monthly overhead you can have, including your mortgage payment, right? So it's at a 43% DTI, right? So it used to be higher, so a lot of people were able to qualify. So since it changed, people get less home. So sometimes they don't want to get less home, so they don't go with the CalHFA, all right? So if you want to look at CalHFA rates, I'm going to teach you right now how to read the CalHFA rates, right? So there is a link I said on top, right here, right? Right here, the rates are right here. So this first one right here is the no zip, which means you're not even borrowing the down payment. Typically, no one goes for this version, right? So here's the regular conventional version. This is the home ready version, which means you have, if you're in lower income, you might qualify for this version, right? Here is just the no zip. Here is the 2-zip, and here is the 3-zip, right? If you want a copy of this, like I said, you could go online and see it, but when you're looking at it, like I said, the first one, don't even pay attention to it. The second one is the no-zip, right? And then there's the 2-zip, and then there's the 3-zip. Down here, this is where CalHFA beats GSFA. CalHFA goes into high balance, but there's a high balance fee, and you'll see that on the bottom right here. So if you're going to go past in Orange County and LA County, if you're going to go past the standard loan amount, because LA County and Orange County are high cost area, you can go past the standard amount. There is a high cost fee, but you can go at least into high cost, which you couldn't do on GSFA. GSFA does not have a high cost limit, okay? Here's the FHA version, right? Here's the 2-zip. Right, and then there's a no zip. That means you're just borrowing. You're not borrowing. You're just borrowing the down payment. The 2-zip, the 3-zip. I wouldn't pay attention to this VA one or this USDA one, right? There's already 100% financing for those options, so why would you go and, go this other route with CalHFA? But that's how you read the CalHFA website link, right? I will leave you some resources for you to look it up yourself. But here is the CalHFA links to find for resources, right? So here's the website. All this information is on their website, right? I gave you a cheat sheet for you to find the rates better, the income limits, the sales limit, right? And the education course you got to take if you get a CalHFA loan. Mostly down payment system programs will have a class that you have to take. What do we get out of CalHFA, right? I think if you're going with the lower purchase price in the $300, $350, $400, I like the CalHFA, and I'll show you in a second, right? Even though you get up to $10,000 in closing costs, for example, you're buying 400 grand, right? You have to come out of pocket 2 grand more, right? If it's, let's say 3%, for easy numbers, right? It's 12,000. You have to come out of pocket 2%, right? I mean $2,000, and then the rest of the down payment. I mean, the rest of the closing costs. You'll see that GSFA doesn't give you enough for closing costs. You're coming out of pocket on a lot of closing costs, but it does benefit you because it's a gift, and we'll go over that in just one second. But pound for pound, CalHFA, it's a strong loan. Majority of lenders can do it. If they're not doing it, I don't know why they're not. They are available to everybody. But the two big changes are they went from 640 to 660 credit score, and they went from 45% DTI to 43% DTI. And the down payment went from covering 100% of the down payment up to $10,000, okay? So it depends on how much you want to come out of pocket, right, guys? So CalHFA is a great loan, but it might not be for everybody, okay? Let's get into the next one. Right? Welcome to GSFA, the #1 contender against CalHFA for down payment systems. The Golden State Financial Authority Platinum Program. If you are in the medical field, if you're in the teaching field, if you're in the fire department field or the police department field, or you support these people in their field, right? Then there's something called Platinum Select, which means you can get 5% of the purchase price as a gift towards a down payment and closing costs, right? It's a very popular deal right now. The difference between the Platinum Select and the Platinum Select is a gift, which means the money is forgiven ASAP. The Platinum, the regular Platinum, compared to the Select, the money is forgiven in 3 years. After 3 years, you don't have to pay it back. Unlike the CalHFA, you have to pay back the down payment and the closing costs, right? So now we're gonna see, you guys starting to see this? I'm gonna show you pound for pound examples on 300,000, 400,000, and 500,000 as well. If you have a specific purchase price or specific home that you wanna buy, of course, we're always here available to go over the payment for you with you at 714-909-1533. Call or text. All right, let's get into it. GSFA Platinum, okay? So there is a conventional version and then there's a FHA version, just like CalHFA. First time home buyer means you can't own a home for the past 3 years. You must buy it owner occupied as well, right? Single family homes, PUD condos, okay. Same thing for FHA, right? For FHA, for manufactured homes, you need a 680, okay? And then for CalHFA, all you need is 660. On the Platinum, conventional, you need a 640 credit score, right? On the FHA version, you need a 660 credit score, right? Income, the conventional one, right, has an income limit, right? There is an AMI limit, right? I think I'll announce in a second. It's called an average. Let me see now. That's bothering me here. It's called the average median income, right? So it has the average median income. So there's an income limit on conventional, but there's a no limit version for conventional, which has a higher rate. And I'll go over that in just a second. But on the FHA version, pound for pound, no income limit, okay? DTIs on this thing, 45 to 50%. So if you have people living in your house, that's gonna help you with the payment, but they can't go on the loan, it allows a higher DTI, right? So you don't have to be at 43, you can be at 45 or 50, right? But the rates are a little higher, so you do need the leeway, right? You can borrow on the conventional from 3% up to 5%. On the FHA version, 5%, right? So the FHA, you can see that's a lot more flexible. Closing costs are normal, just like all down payment assistance. It's just regular closing costs, and most lenders can charge you between 1% to 2%, right? Typically, industry standard is about 1.5%, but lenders, they cannot overcharge you more than 2%, okay, for origination. Because, like I said, you're taking a higher rate, but the money goes towards your down payment and your closing costs. That's why they have to increase the rate, right? Max loan amount, the 510, 400 on conventional, 510 for FHA. But if you're in Riverside or San Bernardino, I know the loan amounts are in the 450 ranges. So make sure you pay attention to the county loan limit, right? Definitely check that out right there. So you can see Platinum's a lot more aggressive, right? So that's why as CalHFA became more conservative, Platinum became more aggressive, right? Which are allowing people to get into a home, right? Some of you guys are going, well, they shouldn't be buying a house if they can't afford it, right? It's called down payment assistance. They're still coming out of pocket with a little bit less. Doesn't mean they're not coming out of pocket. But in a buyer's market, these down payment assistance, they flourish because the seller can cover costs, or if you can convince the seller to cover costs, you come out of pocket less with down payment assistance, all right? Hopefully that helps, right? Here we go. How does GSFA Platinum work? This is what we're talking about here. GSFA does have an open door program, but it's just like CalHFA. You're borrowing the down payment and closing costs. You can borrow up to 7% to cover down payment closing costs, but the rates are in the 5s, which is kind of nasty right now. So we talked about the open door before. I'm not getting to it again because I didn't get a lot of good vibes on it. So that's why we did this video to show CalHFA versus GSFA. Who is the champion, my friends, right? GSFA Platinum can help first-time home buyers up to 5%, right, to cover down payment closing costs. Not up to $10,000. So when you start getting the 400s, 500s, right? You get you get a gift for the complete down payment. So if the down payment is 15 grand, you're getting 15 grand, not 10 grand. You got to come out of pocket 5 grand. Okay. So when you're doing these programs, closing costs is about 2.5 to 3%. Well, you can finance closing costs. Well, typically right now, not a lot of sellers are not covering your closing costs, and depending where rates are at, you might need down payment assistance to cover down payment and closing costs, right? If you don't have enough money. So here, 2.5 to 3%, right? Remember, the money is forgiven. Unlike the CalHFA, right? The money is forgiven. So after 3 years, the 5% that you're getting towards down payment and closing costs is forgiven. But if you can get the Platinum Select, right? Because you are in the fireman industry, right? The police industry, teaching industry, or medical industry, right? After 6 payments, you can take that high rate and do a refinance to reduce the mortgage payment, right? You can reduce it to a regular loan. That's why the Select is so awesome. If you're a first responder, right now, we're responding back. Hopefully you thought that was funny, because I thought it was, right? So remember, there's 2 versions and multiple levels, okay? Platinum Select. Let me get into the poll. Let's punch up one more time the Platinum Select jobs here for you guys, right? So in April this year, they added medical, right? If you're in the medical field, peace officer, sheriff, border patrol, correction officer, any service in law enforcement capacity, fire department, firefighters, CAL FIRES, paramedic, and emergency medical tech, right? Anyone in administration staff that supports fire department, right? You're good in our books, okay? Current members of the California State Teachers Retirement System, right? Or as long as you work for an accredited school in California, you are good. You could be in the admin staff as well. You do not need to teach, but you get that 5%. That is a gift, which is forgiven instantaneously. Okay, so after 6 payment, you can reduce your rate. Here we go, right? Next thing, before we get into the programs, right? There's something called AIM. When you're going conventional, right? There's 2 types of conventional products. There's ones where you're under the area median income by 80%, right? You're under by 20%. So you take the area median income, subtract 20%, right? If you fit in that category, you get a different rate, right? If you don't, you can still get Platinum, but it's a different program, okay? That's why I see a lot of people go with the FHA version, because they want that full 5%, right? So it would be hard to find someone under the 80%, the area median income, okay? So let's break down the GSFA, okay? So right here we have on top, I left the link here that you guys can look up the rates anytime you want. Guys, that's what we're about here on What's a Mortgage. We're about transparency. On the CalHFA site, I left the rates. On the GSFA, I left the link for the rates as well, right? So here is the FHA version, right? FHA version right here. See, there's different levels. There's 0, which you're not going to go. You're either going to go with the 3, the 4, the 5. The rate is 3.625. That money is going towards your down payment and paying the lender's commission. You got to pay for the rest of your closing costs. Remember, they're giving you a higher rate to cover the fees and your down payment, right? The conventional versions, like I said, there's the under 80% AMI. You can get up to 5%. If you make over 80% of the AMI, you can only get 3%, okay? Hopefully that makes sense to you and you understand. If you don't have a clue, which is fine, right? It's your first home. I know I talk really fast. I'm sorry. You can watch this video again. It will be on Facebook. I'll be putting up on YouTube in the next couple of days. But definitely, if you have questions, always call us, 714-909-1533. Okay, next slide here. Remember, 40 to 50% DTI, so it's allowing a higher DTI threshold, right? If you're buying with a GSFA. So pound for pound, they're more flexible, but remember, they're giving you the down payment and the 1.5 to cover the lender fee, right? You still on GSFA have to cover the closing costs, which is 2.5 to 3%. You got to come out of pocket, right? If you're working with the right lender, if you're working with the right realtor, try to negotiate, if you're going GSFA, for the seller to increase the purchase price to cover 1 or 2% of your closing costs. If it works a lot easier, of course, if you're Platinum Select, you're like, Make sure you have your realtor write a letter. This buyer is a first responder. This buyer is a fireman, police officer, teacher, or helps out in that field, right? They really want this house and their budget is for so-and-so. We're not asking for a deal. We're just asking if you can increase the purchase price by 1 or 2% and give it back as a seller credit. Most likely, any seller would touch their heart. They would go ahead and do so, right? So definitely, guys, you got to work with the right realtor. You got to work with the right lender and make sure you budget that closing cost, all right? Next one. So, Platinum versus GSFA. Here is a $300,000. Here's what you guys all been waiting to see, right? Right here, at a combined weight of $300,000. Some of you guys are thinking, there's no $300,000 house. Here at What's a Mortgage, right, we don't discriminate against purchase price. If you're buying a house for $300,000, good for you. At least you're going to do something about it instead of sitting there not doing anything, okay? So if you're in Central California, you're in San Bernardino, right, and there's $300,000, here we go. So we did pound for pound. CalHFA right now, 3.125. Platinum right now, 3.625. $300,000, right? Net, your principal and interest payment, $1,343, $1,261, right? So you can see it's almost $100 more, right? Total, let me see, total net, that's the principal and interest payment, tax, insurance, total estimated payment, right here. You got $1,935 on a Platinum and $1,854, right? It's about $80 more. Out of pocket, $10,000, right? On a Platinum. Estimate out of pocket $10,000 on a Platinum. Out of pocket for a CalHFA $6,000. Well, that sounds great. It's $100 cheaper and it's $6,000, but you still owe that additional $18,000. So when you sell or refinance, which means you're probably not going to refinance for a while, you're going to keep this loan. When you sell or refi, you got to pay off this $18,000. But remember, you came out of pocket $6,000. This is $10,000, so there's a $4,000 difference. So this one, you're pretty much $8,000 more, but you're saving close to $80 a month, right? $70, $80 a month. Only you know what's best for you and your family. Remember, this one, it will be forgiven. You won't, or you sell or refi, you don't owe anything after 3 years. If it's select, you get it forgiven like that, right? Hopefully, guys, only you know what's best for you. For me on this one, I net would go with the CalHFA. Probably won't be moving for the next 5 to 10 years. I'll use equity one day to pay off the difference. For me, cash is king. I would go CalHFA. That's just me. But everybody has their own interests and their own agendas, and make sure you do what's best for you and your family, right? End of the day, I'm not making your mortgage payment. Your realtor's not making your mortgage payment. Your lender's not making your mortgage payment. You are. You got to live with it, all right? So next one. The battle of the $400,000 purchase prize. Let's see who is the winner here. Same thing, 400 grand, 3 1/8, 3.625, right? Your total principal and interest payment on CalHFA is $2,472. And your total over here is $2,581, right? So this one's about $110 more on the Platinum. Out of pocket, $10,000, but you don't owe anything afterwards. With the CalHFA, you're out of pocket $8,000, so $2,000 more, but you owe $21,000 left, right? The other one, 3 years, is forgiven. $100 for 3 years, that's $3,600. Plus the $2,000, it's only $5,000 more. I would go Platinum. That's just me, right? Some people just want to come out of pocket $8 grand, but 21 grand, okay? Last but not least, $500,000, right? $500,000. Who is the champion, my friend, right? 500 grand, pound for pound, right? What do we got here? 500 grand, rate stays the same. Right? Total monthly payment, $3,090. Right? Total monthly payment, $3,220. 26. You rent a house for 500 grand, it's probably the payment's probably gonna be 25 or 2,600 bucks a month. So you're gonna pay a little more to own, but eventually you will own it. Okay. Estimated out of pocket $10,612, and you owe nothing afterwards. CalHFA, $10,271. So $400 more, but you don't owe the $24,000. So pound for pound, this one is obvious. Go with the platinum. Like I said, the lower purchase price, CalHFA sounds good. But remember, platinum doesn't go in the high balance. If you need to go high balance, and you're in Orange County or LA County, you're gonna go past that 510, right? Then definitely make sure you go CalHFA because they do high balance, right? So definitely, guys, right there, pound for pound, we know who is the champion. Last but not least, here is our GSFA links and resources for those of you who want to look up the information. We got the GSFA website, where to find interest rates, income limits for conventional, right? Sales price too. Also, guys, there is the link for the course. So before you do any CalHFA home ownership, right? Enter into CalHFA or GSFA, they all have their classes. Make sure you take the classes up front so you don't get stuck in escrow, and you can't close escrow until you do the class. So definitely, are you looking for more answers, or do you have more questions? If you do, call me 714-410-5556.